When you're starting a business, choosing a structure feels like, it feels like boring paperwork. But what if I told you that simple choice could be secretly costing you thousands of dollars every single year? Today, we're going to flip that script. We're turning that chore into a strategic weapon to upgrade your business from a liability into a real wealth-building machine. So let's just ask the question straight up. Is your business structure a hidden tax? Because that default setup, the one that's super fast and totally free, it might feel like freedom at first. But as your business grows, that simplicity starts to silently drain your profits. And the worst part is, you probably won't even see the damage until it's way too late. Okay, here it is. This is the first number that shocks almost every new entrepreneur. 15.3%. What is that? That's the self-employment tax. See, when you're the boss and you're the employee, the IRS says, hey, you gotta pay both halves of the payroll tax. It's a massive, massive hit to your bottom line. And believe me, it is just the beginning. And that huge tax hit leads us right into what a lot of experts call the simplicity trap. That initial advantage, being so easy to set up, it quickly turns into a huge financial and, frankly, a huge legal risk. Let's break down exactly why the easy way isn't always the smart way. A sole proprietorship is the default for a reason. It's effortless, right? No paperwork, you just start. But I want you to pay very close attention to that last sentence on the screen. Legally, the owner and the business are the same entity. That one simple fact is the source of two massive, and I mean potentially catastrophic problems for you. It's a real double whammy. First, financially, you get slammed with that full 15.3% self-employment tax, and then you still have to pay your regular federal and state income tax on whatever is left. But honestly, the bigger risk, the one that should keep you up at night, if your business gets sued, there is zero distinction. You get sued. Your house, your car, your personal savings, it is all on the table. As you grow, that's a gamble you simply cannot afford to take. Okay, so how do we fix this huge liability problem? It's time for our first strategic upgrade. It's time to build a fortress, a protective shield around your personal life and your personal assets. And that upgrade is an LLC, a limited liability company. The whole purpose is right there in the name, limited liability. It creates a legal wall between you and your business. They become two separate things. Now, this part is absolutely crucial. By default, an LLC doesn't automatically change your taxes, but what it does do is create that legal separation you desperately need to protect your personal wealth. But listen, just forming the LLC is only step one. If you want that protective shield to actually work, you have to operate like a real business. That means getting an EIN from the IRS, opening a dedicated business bank account, and I cannot stress this enough, never, ever mix your personal and business funds. That mixing, it's called commingling, and it's the fastest way for a lawyer to argue that your shield is worthless and come right after your personal assets. All right, so once that legal shield is up and strong, we get to the really powerful part. We get to add a tax-saving engine to our new structure. This is where the strategy really starts to pay off, potentially unlocking thousands of dollars in savings every year. This quote just says it all, doesn't it? The tax code isn't just a bill you have to pay, it's a system full of incentives. Having the right structure in place is what allows you to play the game to your advantage and to do it completely legally and ethically. So here's the key mechanism. Your LLC is incredibly flexible. With one simple form filed with the IRS, you can choose for it to be taxed as an S corporation. Now, you're not changing your company legally. It's still an LLC. You're just changing its tax status. It's a pure strategic tax move. And believe me, this move is a total game changer. As a sole proprietor, if you make $100,000 in profit, that entire amount gets hit with the full 15.3% tax. But with an S Corp election, you basically become an employee of your own company. You get to split that profit into two buckets, a salary and a distribution. And that changes everything. So here's how that tax-saving engine actually works. First, you pay yourself a reasonable salary, basically what someone in your job would typically make. That salary, that gets hit with payroll taxes, just like a normal job. But the rest of the profit, that can come to you as a distribution, which is not subject to that nasty 15.3% tax. That's the loophole. That's the savings right there. Now let's look at the real world numbers, because this is where it gets exciting. On $100,000 of profit, the sole proprietor is paying over $14,000 in self-employment tax. The S Corp owner, they're paying just over $9,000. That's almost $5,000 in savings every single year. That's money you can put right back into your business, in your savings, into your future. So look, having the right structure is step one. But step two is learning how to operate it correctly. To really, truly maximize the benefits of this thing, you have to start using your business as a tool for financial efficiency. As a business owner, you get to play by a different set of rules. You can deduct expenses that are ordinary, necessary, and reasonable for your business. We're talking about things like your home office, your vehicle mileage, marketing costs, software you use, professional fees. Every single legitimate expense you track and deduct directly reduces your taxable income. So what happens if you're out and you accidentally use a personal card for a business lunch? That's where something called an accountable plan comes in. It's the formal IRS-approved way for your business to pay you back for that expense, tax-free. All you need is proper documentation, the receipt, and a note about the business purpose. It's a critical little tool for keeping your finances clean and that protective shield intact. Okay, the final, and I think the most important upgrade, isn't a form you file or an entity you create. It's a shift in your mindset. It's about moving from being a reactive taxpayer to becoming a proactive financial strategist. The reactive taxpayer, well, they just earn money all year and then worry about taxes in April. They see the tax code as a punishment. The proactive strategist plans ahead. They see the code as a system of incentives, and they use their business structure to their advantage, legally cutting their tax bill while shielding their assets at the same time. And this kind of strategic thinking is completely scalable. I mean, the biggest enterprises out there don't just have one company. They have a whole network of them. Each part of the business might be in its own separate LLC, all under a parent company. Why? This compartmentalizes risk. It means a lawsuit against one part of the business can't sink the whole ship. It's the ultimate protective structure. So I'll just leave you with this one question to think about. Are you just trying to survive this tax season, or are you trying to build an empire? Is your business structured just for this year, or is it structured for the next generation? The choice to upgrade is so much more than a financial decision. It's about the future of everything you're working so hard to build.